Hey there, investors. Welcome back to another market update. Inflation is the talk of the town, and it's been on everyone's mind lately. But today, we just got some promising news that could change the game. The Fed's favorite inflation gauge, the PCE Price Index, showed signs of cooling down in June. This is a significant development. This is a big deal because it could mean the Fed might ease up on those interest rate hikes, which have been a hot topic. Let's break it down. Understanding this can help you make better financial decisions. Remember, inflation is like a sneaky tax that eats away at your hard-earned money. It's something we all feel. When prices go up, your dollars don't stretch as far, making everyday items more expensive. That's why the Fed has been raising interest rates to try to cool things off and bring inflation under control. And you know what? It seems to be working. This could be the glimmer of hope we've been waiting for in these challenging times. The PCE Price Index, which tracks what consumers are spending their money on, rose by 2.5% in June compared to a year ago. This index is a crucial measure used by economists and policymakers to gauge the overall health of the economy. It reflects the changes in the prices of goods and services purchased by consumers, providing a comprehensive view of inflationary trends. That might sound like a lot, but it's actually the smallest increase since October 2021. This indicates that inflationary pressures are beginning to ease, which is a positive sign for both consumers and businesses. Lower inflation can lead to increased consumer confidence and spending, which in turn can stimulate economic growth. Even better, the index only ticked up a tiny 0.1% from May to June. That's progress, folks. Such a minimal increase suggests that the measures taken to control inflation are starting to have an effect. It also means that the cost of living is stabilizing, making it easier for households to manage their budgets. Now let's talk about core inflation. Core inflation is a critical metric because it excludes the often volatile food and energy prices, which can fluctuate due to factors like weather or geopolitical events. This measure strips out volatile food and energy prices, giving us a clearer picture of underlying price trends. By focusing on core inflation, we can better understand the long-term trends in the economy without the noise of short-term price spikes. Core inflation rose 0.2% in June from the previous month and 2.6% from a year earlier. This steady increase suggests that while overall inflation is easing, there are still underlying pressures that need to be monitored. Policymakers will continue to keep a close eye on these trends to ensure that inflation remains under control. The fact that core inflation remained relatively stable is a good sign. It suggests that the Fed's rate hikes are starting to have their intended effect without causing prices to plummet. Remember, the Fed is aiming for a soft landing, slowing down the economy just enough to tame inflation without triggering a recession. It's a delicate balancing act, but the latest PCE data suggests the Fed might be on the right track. Section 4. Spending and income. Rise consumers keep the economy humming. In this section, we delve into how consumer behavior is a driving force behind economic activity. Meanwhile, American consumers are still opening their wallets, which is good news for the economy. This continuous flow of spending helps businesses thrive and keeps the economic engine running smoothly. Personal income, the money we earn from our jobs and investments, inched up 0.2% in June. This slight increase, though modest, adds up over time and contributes to overall economic growth. And what did we do with that extra cash? We spent it. From buying groceries to enjoying leisure activities, consumer spending is a vital part of the economic cycle. Consumer spending rose 0.3% in June. This uptick, though seemingly small, indicates a healthy level of consumer confidence and willingness to spend. This tells us that consumers are still confident about the economy, even with inflation and higher interest rates. Their spending habits reflect a belief in the stability and potential growth of the market. Of course, we can't ignore the fact that the personal savings rate dipped to 3.4%. This decline suggests that some consumers are using their savings to maintain their current lifestyle amidst rising costs. That's the lowest level since January and suggests some folks might be dipping into their savings to keep up with rising prices. This trend highlights the delicate balance consumers must maintain between spending and saving in today's economic climate. Section 5. The Fed's scorecard, PCE, and the path to rate cuts. Now, why does the Fed care so much about the PCE price index? Well, it's their preferred measure of inflation. They use it to help them decide whether to raise or lower interest rates. The Fed has a target inflation rate of 2%. They want prices to rise gradually over time, but not too quickly. The latest PCE data suggests that inflation might be finally starting to cool down. This could give the Fed some breathing room to pause their rate hikes or even start cutting rates in the coming months. Section 6. Markets react. Optimism on Wall Street as inflation eases. And guess what? The markets are feeling optimistic. Stock futures moved higher after the PCE report was released, suggesting that investors are hopeful about the future. Treasury yields, which move opposite to bond prices, also dipped. Market analysts are also weighing in, with some suggesting that the Fed might be nearing the end of its rate hiking cycle. Of course, we'll have to wait and see what the Fed decides at its next meeting in September. But for now, the latest inflation data is a step in the right direction. Stay tuned, investors.